Hi, good afternoon, folks. So, welcome to the Fund Helpline channel. Today we'll discuss a new topic, that is the debt mutual fund, the concept of debt mutual fund. So, this will be basically the 4 to 5 video. We'll do it in series because debt mutual fund is a very vast concept, and it is not possible for us to do it in a single video. Then it will take more than an hour. So we decided to do around 4 to 5 videos where we'll cover the entire debt mutual fund concept, advantages, what we need to look at in the debt mutual fund when we are doing the investment, and also we'll discuss about the current scenario. In current scenario, what is the how the debt funds are looking, and what are the investment opportunities there. We'll discuss about the different debt market strategies and how they are efficient into the different economic cycle, different market cycle, that we'll discuss. So we'll do it in a 4 to 5 different videos starting today. So today we'll basically discuss about the concept of the debt mutual fund, different categories in debt mutual fund, and advantages, disadvantages of the debt mutual fund, and how you can get benefited, and what are the opportunities of investment in the debt mutual fund, and how this debt mutual fund is efficient than your fixed deposit, that we'll discuss today. So let's begin. Before beginning, we know that in current market situation, the debt mutual fund, if you see that the past 5 to 6 months return of the debt mutual fund, or even 1 year return of the debt mutual fund, it's not very attractive. So there is everybody thinks this is not a product we should look at. The return is very poor. So believe me, friends, debt mutual fund is very efficient product. Maybe the 6 months or 1 year return looks not attractive, but it should be a core of your portfolio. If you are investing any money into the mutual fund, or investing into the fixed deposit or fixed instrument, whatever money you are investing into the equity fund, you should put at least double your money into the debt categories, and whatever the money you are putting into the bank fixed deposit, you should put that money into the debt mutual fund. And this debt mutual fund should be your core portfolio, and if it will give you the return better than the fixed deposit in a short term, long term, medium term, and all different market cycles. And how we will get the return better than the fixed deposit, and what are the past return, we will analyze in 10-15 years, 20 years past return into the different market cycle, how the debt fund had given, and what are the return debt fund had given compared to the fixed deposit. That we will be discussed in next few series of our videos. So let's start. So what is the debt mutual fund? First question is, what is debt mutual fund? The debt mutual fund, basically, whenever any companies is taking the loan, that is called debt. Whenever if you are giving the money to the in a debt mutual fund, means the fund manager is investing into that company's debt products, be it government, be it private corporate, be it banks. So there are different debt instruments. You may be heard about the GSEC, NCD, corporate bond, gilt, treasury bill, CP, CD. These are basically your debt instrument, where generally a debt mutual fund put the investments. So let's understand what are these different instruments is all about. The first is the gilt. Gilt means is your government securities that is issued by the RBI behalf of the government of India. So thus the government of India collect the money from the public. This is called the gilt. Next is your corporate bond or the NCDs. The NCDs is full form is non-convertible debenture. This is issued by the different corporates. Thus these corporates collect the money from the public. Before the collecting the money, they get the permission from the different agencies like your SEBIs, RBI, different regulatory bodies. Thus they can raise the money through these NCDs. Next is your certificate of deposit. This is issued by the different banks. This is called certificate of deposit. This is called CDs issued by the different banks for the short term up to 1 year. Generally bank collects this money up to 1 year. These are issued, bank issued these to different institution, means different, these are mutual funds, and there are different primary dealers who basically purchase it from the banks. Then there is a commercial paper. Commercial paper is issued by the different corporates, NBFCs. This is also a short term instrument where these corporates raise the money from the short term. So these are the basically instrument. Apart from that, there is a treasury bill, 90 days, 180 days, 60 days. These are instrument of government of India issued. So this is also one of the instrument that is issued for the short term. So these are the basic instrument of debt. Now the next question is what is the advantage of investing into the debt mutual fund. The debt mutual fund, as I told earlier, it is quite efficient in terms of giving the return. If you see that the return of past 10-15 years, long term return, the debt mutual fund has beaten the fixed deposit return. In terms of taxation, debt mutual funds are better and efficient, because if you are investing in a money, you are putting in a money into the fixed deposit, the fixed deposit will charge you the taxation as per your income tax slab. But if you invest in a debt mutual fund, you will get the indexation benefit, and after that indexation benefit you need to pay the tax. Thus this is quite efficient for the, especially for the high tax bracket investor. Apart from that, there are different categories in debt mutual funds. There are today there is almost 16 categories in the debt mutual fund as per the SEBI's classification in the year 2018. So as per your requirement and the time horizon of your investment, risk appetite, you can invest, you can choose and invest accordingly. Huge liquidity benefit. Debt mutual fund, there is no lock-in as such, so you can withdraw money anytime whenever you required. In case of fixed deposit and other instrument, they charge you if you withdraw before the time, the rate of interest goes down, so that will hurt you. But in a debt mutual fund, you can withdraw money anytime, so there is a huge liquidity options available in the debt mutual fund. Even another more important thing is, in debt mutual fund, if you have invested say 1 lakh rupees in a particular fund, but you need only 10,000, here you can withdraw. The partial withdrawal is possible, 5-10,000 you can withdraw, so no issues. But in a fixed deposit, if you want to withdraw the money, then you have to break the fixed deposit entirely. So these are the very basic advantage of the debt mutual funds. Then what are the disadvantage of debt mutual funds? Yes, there definitely each and every product has some advantage and disadvantage. So debt mutual funds will not give you the guarantee return what a debt basically a debt investor is looking for, right? Whenever you putting money into the debt and you used to get the from FD used to get the fixed return, the FD where is the it is written that they will get this percentage of return, but in a debt mutual fund the company will not guarantee you or not giving anything in writing that the what is the return percentage of return that you will get, because the debt instruments generally traded into the secondary market. So every day there is a price fluctuation, though this is not the fluctuation like what happened in the equity market, but yes, there is a purchase sale happen into the secondary market, thus the price discovery is happen. So there is a minor fluctuation every day you will see. Thus no debt mutual fund will give you the what is the return that will get, it is the NAV, from there will get the price. So what you need to look at, you need to look at the past return, though the past return is not guaranteed, and there are a lot of debt mutual fund, there are some categories of debt mutual fund which are basically return is cyclical in nature. So there the past return, if you look at the past return, then you will be totally be fooled. So for that you need to understand the debt mutual fund concept. So that is why we are doing this series. We'll discuss what are the important things you need to look at and how you can analyze a debt mutual fund and how you can understand what is the when to invest in what kind of fund and how need to look at all these fund categories and how you can analyze the fund in details. So apart from that, if you are a investor, you don't have time and don't have the don't want it to understand all these things, you can definitely take the help of the financial advisors or any expert which you know. So thus you can take the help of that and can invest. So this is one of the disadvantages of the debt mutual fund, that you will not get any guarantee. Second, the debt mutual fund, whatever the indexes benefit you get only if you invest for 3 years. But if you don't invest for 3 years, then there will be a short term capital gain that will be applicable. So there you will not get the indexation. Third point, sometime in a biggest economic crisis, there are a lot of liquidity crunch in a debt market had happened. So though this is a very specific situation, but in 2020 in the corona crisis the situation happened, there is a huge crunch into the debt market, and definitely some extent debt mutual fund has given the negative return for some period of time because of the liquidity issue. Why this is happened, that I am not discussing over here, but still in some categories of debt mutual fund there is some problem of liquidity, and because of that you can see that the price erosion of debt funds. So these are the basic disadvantage you can have for the debt mutual fund. Now we'll go forward and we'll discuss the different categories of debt mutual fund and how one can invest and how one can look at the different categories, how they can invest in these categories of funds. First, you need to divide the debt mutual fund. We can divide basically into the 3 categories. One is the liquid, second is the core, and third in the satellite basket. So liquidity, but liquid fund, which is basically the overnight fund, and the liquid fund, these are basically the parking place, means whenever you have any money, rather than keeping the money into the banks, if you have the current account, you don't earn any money from the current account, so you definitely park the money into the liquid fund or overnight fund, so you can get some interest rate. interest from there. So from this fund anytime you can deposit, anytime you can withdraw, no question asked, no charges, nothing, and expense ratio is very minimal. So this is a very efficient instrument. If you have any liquid money sitting in your bank account, you can park this money to these categories of funds and get some benefit from there. Second is your code basket. Code basket means the kind of a debt mutual fund. You can put the money in all season, means anytime you can invest in these mutual fund, these debt fund categories, and there is hardly any, there is no such price fluctuation in these categories of funds. These among these categories in a core bucket, there are some fund like your short term fund, ultra short term fund, corporate bond fund, medium term fund, banking and PSU fund, and basically money market kind of a fund and all. So these are basic category of debt mutual fund which is should be in the part of your core bucket. These are basically the accrual fund where you get generally whatever the bond yield is there, you get that kind of a return. So whenever you are investing into this kind of a fund, you need to look at the YTM of the funds, and that will indicate some return of yours. Obviously fund having the expense ratio, the YTM minus expense ratio will give you the idea, the exact idea of a return if you hold the fund till the maturity, means whatever the duration of the fund, if you hold till duration, so it will give you the indication of the return what you can get. So these are category of fund where there is no such credit risk or interest rate risk. So anytime entry, anytime exit kind of a fund. For short to medium term investment, you can invest here from say 6 months to 2 years, 3 years kind of a horizon. Generally your short term fund, ultra short term fund, you can put money for a year or two. For medium term fund or corporate bond fund is for 2 to 3 years kind of a horizon. So you need to look at the fund duration and all, and as per your investment horizon also is very important. So the fund which will that will match your investment horizon, you definitely try to put the money on those funds only. So this is a core category. Here you should put, if you are a layman kind of investor, don't have very big idea about the mutual funds and all, generally you should take around 50 to 60 to 70% kind of exposure in these categories. If you see the long term return of this fund is compared to your bank FD is better, and when you comparing the return with the bank FD, you need to compare it with the different market cycle, different time period and all, then only you will get the real picture. Next is your satellite bucket. The satellite is basically the opportunistic bucket where there could be some volatility, or this is not for the long term, this is for the for specific time period investment. Here you can look at the categories like credit opportunities, gilt, long term, long to medium to long term fund. These are basically the satellite bucket, and also the dynamic bond fund. These categories of fund, they take generally interest rate risk and the credit risk. Some of these fund like your gilt fund where there is a no credit risk, but it's basically play on the interest rate risk. There is a interest rate because these funds basically do well when the interest rate goes down, and when the interest rate goes up, these funds generally don't give much return, rather the return is very poor. There are categories like credit opportunities fund, which is basically the play on the different corporate credit market. So these fund are this problem with having the problem with the credit. There is, if the credit market corporate, there is a problem or company specific problem, or there is a credit crunch, liquidity crunch into the market, these fund face the problem. So you need to understand the, you need to go by the fund to fund and understand the details, nitty gritty of the funds. We'll discuss the different points in the next few videos. We'll discuss in detail about these categories of fund, how you need to look at all these fund. So this basically credit fund having your high credit risks, as the name suggests. Then there is a dynamic bond fund, which is basically play on both some extent on credit and some extent on the your duration in the interest rate cycle. So these categories of fund can take both kind of risk, credit and the interest rate. So these are opportunities bet, and these fund in the different market cycle, they give extraordinary good return, like your gilt fund, dynamic bond fund. So you need to understand the fund risk return, means fund, what is the different risks they are taking to generating return. You need to understand these in details, then only you should invest in these categories of fund. Apart from that, the long term fund and the medium to long term fund also have some play on the interest rate side and some into the credit side. So depending on company to company, the rate both is varies. To some fund having the high duration take the high duration call, so that is basically into the interest rate play. Some fund the play take the lower rated corporate papers, so that is on the interest rate play, that is basically the credit play. So you need to understand the fund by fund, and then only you can invest. So basically if we this is the kind of a three basket where you can choose the fund and invest accordingly as per your investment horizon and risk appetite. In the broader sense, we can basically divide the fund risks in three categories. In debt, basically in debt mutual fund, we can divide the risk in three categories. One is there is a credit risk, one there is a liquidity risk, third is the interest rate risk. Apart from that, interest rate risk or macroeconomics risks or the global risks, the market risks and all. So these are basically three categories where you can divide the debt mutual fund risk into these three categories. So different fund having the different kind of a risk, and so the return will be return will be, it is a part of the risk. So if you take the high risk, then chances of getting the high return. But if you stick to the very quality portfolio, the obviously you will not get very extraordinary or ordinary return, you get the return on an average basis. So these are the basically different kind of a debt products that we have. Broadly, we can also categorize the debt product into the two bucket. One is the duration category, one is your accrual category. Accrual categories of fund, as I have discussed earlier, these are basically funds which is based on the which is give you the return based on the what is the coupon rate of the fund, coupon rate of the bond over there. So that you can find from the in a fact sheet. In a particular fund, you see the yield to maturity of that fund, and you can means from yield to maturity you deduct the expense ratio. That will give you the basic idea, but it will not give the exact idea that I am telling you, but it give you the basic idea of the return of the fund, what kind of return you can expect from this fund. Then there is a duration kind of a fund. This is basically the play on the interest rate risk, the interest rate call. Here the fund manager, different companies, different fund having the different rate of interest rate, they take the, here the fund manager play on the interest rate cycle. They buy some bond, they sell some bond, they means change the portfolio as per their understanding of the interest rate cycle and economic cycle. So here you will not get the idea from the fact sheet. The fact sheet will maybe give you the basic idea, but you will not get the exact idea what kind of return you are expected. But one need to look at, whenever you are taking the duration risk or you are investing in the duration fund, you need to look at the interest rate cycle. You need to understand where we are now in the interest. If I just wanted to invest the money today in a duration category of fund, we need to understand few things. Currently where we are in the interest rate cycle, in the next few months or years, that is generally next 6 months to 1 year, whether the interest rate will go up or it will go down. If the interest rate is expected to go down, definitely the duration fund is a good bet right now. But if the interest rate expected to go up, then definitely this fund is not a very suitable in the current situation. So you need to understand in detail, and you need to look at the portfolio of the fund duration, average maturity, modified duration, and the different instrument in the fund. Then only you can decide which fund to choose. So how to choose the fund, that we'll discuss in some later videos. We'll discuss in detail. So that is for today. That is just we wanted to basic idea, just we wanted to share in today's video. So hope you have understand the basic idea about the debt mutual fund. So if you like this video, please share it to your friends and families, and subscribe to this channel, so whenever the next videos will come, you will get a notification. So again, thank you very much for listening.